great, so really appreciate it again. And good, sound looks good, everything looks good, so let's get rolling. So we're going to talk today about, earnings season unofficially kicks off this next Monday with Alcoa. So we're going to talk about getting you ready for an earnings season and how to profit from an earnings season now, a trader's game plan. Whoops. So, okay, so I'm going to go through kind of a 5-step plan that I put together and I use. And first off, it's how do you find volatility and then use it to your advantage. A screening process that I put together to find the kind of most probable high winning type trades for these setups. A vital stock trading checklist to make things very systematized. My favorite trading tools for these earning type trades, and favorite non-directional earnings release and pre and post earnings trend type strategy. So the following webinar is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. So been actively trading for over 30 years and previously ran I was executive vice president for one of the largest all trading companies in the world, Transworld Oil, and ran their international trading desk for over 10 years out of the beautiful island of Bermuda. So it was a great experience for me, just from a standpoint of living there for over 15 years and then trading and all the things that I learned. We were really large and big into oil, but we also diversified out and got into all the other derivative markets, all the different futures markets and foreign exchange. So very, very blessed to have had that experience. We were also one of the first groups to trade options and did that on over-the-counter crude oil options. So got my start there with options on crude and just been really passionate about the option markets ever since. Then went on to launch an institutional over-the-counter crude oil options brokerage desk for a company called PVM Oil London, and they're the largest privately owned oil brokerage company. So set up an options brokerage desk for them, and also just another big learning experience. So a lot of fun, but also just a fantastic experience as far as learning more about options. So here's a kind of snapshot of me circa 88. Nice set of hair, nice and dark, no gray hairs. But this is basically when I started trading options. And trading for yourself is such a fantastic job because you can pretty much do it from any place now since we have the internet. But you really need to be educated about what you're trading and stay focused about managing your trading risk. So probably everybody here can also attest to that it can also be a very painful profession at times. So in my opinion, the most important lesson in trading is that you should not just focus on making money, but you really want to be focused on managing your trading risk, and then the profits will come. So today I'd like to get everybody kind of ready, prepared for this earnings season that kicks off next Monday with Alcoa, and there's some really good ones coming up when we have Amazon and Netflix to like. So that's what we're going to spend today talking about, how to get ready for this upcoming earnings season. And it should be an extra volatile one, so if you want to take advantage of it, I'll show you some things you can do. So have you ever been confused by the weird movement in a stock price during its earnings announcement? Have you noticed how earnings can be horrendous and the stock will go up, or earnings can be off the charts fantastic and it goes down? So this is what I call the earnings confusion. It gets so confusing. You're like, what's going on with this? So what is this all about? Now, when a company has an earnings conference scheduled, many times there's going to be speculation, not only into the accuracy of their projected earnings, but also into other factors that they may announce on that earnings conference call. And a lot of times that's going to, be a surprise to the market. And that's what really creates all the uncertainty. So this uncertainty typically causes volatility in the shares themselves. And that's what is the diamond in the rough. It's actually that temporary parabolic increase in the exchange listed options on the underlying stock. So here's what happens. Traders, they'll stay on the sidelines as long as they can. And then all of a sudden going into earnings, they're forced into having to do some type of hedging, either long or short, whatever. So in the days leading up to an earnings conference call, all of a sudden you'll have call buyers coming in, and they'll be looking to swap out shares of their long stock for long call options so they can participate in a rise should the shares move higher, but also limit the potential loss should the shares go down. And then additionally, you're going to have the put buyers coming in, forcing the option prices higher as well, as they try to protect their positions from any major downside movement. So it's all this concentrated option buying in one, kind of a short time frame that will drastically expand the volatility levels of the stock being traded and the options on those stocks going into earnings. And implied volatility and the increase in implied volatility is what is one of the big components that increases the price of your options. So as an individual trader, you can take advantage of this uncertainty and volatility in order to capture profits, no matter what those crazy earnings reactions are, if you just use the right setups. So step one is you want to be able then to identify and qualify a particular stock. And I do this by looking at past performance heading into an earnings release. So you want to look for those stocks that have their earnings release closest to a weekly option expiration or during the week of a monthly option expiration. And the reason I like to do it this way is because a lot of these moves from an earnings release will be a big, huge spike higher or lower, and it can be a huge move. And so you don't want to give the market too much time to let kind of a retracement or a reversion to the mean happen. So you want very short-term duration type option trade setups on what I call these non-directional earnings release type trades. So it falls in really great for using these weekly options. So step two then is I want to look at past performance. So I have statistics on past performance of all the different stocks to see what their volatility has done previously as it moves closer to an earnings release and then even after. And what you're going to notice when you look at, if you go back and study earnings release charts and stuff like that, you'll see that there are a lot of times three different trading opportunities. You'll get the trend trade into an earnings release where you'll have a nice little trend. And then you get that second type trade, which is the kind of the earnings release non-directional trade, which can be explosive up or down. And then the third type trade setup is your post earnings release trade, where it can start maybe trending again. And certain stocks have a higher tendency statistically to do this, these three type trades. Now, the prepared trader then is going to be looking for that dramatic increase in the front month volatility, as that stock that you're watching approaches an earnings release date. So typically a stock's front month volatility will be, around 25 to 40%. But when your earnings are just a couple of days before option expiration, this volatility can easily move to really big extremes. So this is what, again, makes for a really potentially great trading setup. So, again, it's past performance of a stock and the increase in its implied volatility are two really big components. And then I want to look at the implied volatility, and a lot of times you're going to see that normally double and sometimes even go higher than that to even greater extremes. So this is, what we're looking for. This is what I look for, and this is the opportunity that presents to you for earnings type trade setups. So here's an example to show you how that volatility can really spike. Now this is Amazon, and its earnings last quarter were on the 28th. Okay, so you can see that pointer. So if you look at Amazon, you'll see down here in this area that its normal volatility is around 33%. But as you go into the week of its earnings announcement, and this is showing you one day, so the earnings are on this specific day that I took this screenshot on the 28th, and then the actual expiration was the following day. So this was on a Thursday, and its expiration was on Friday. And look at the implied volatility; it's over 133%. The expected move on this stock is over $44 up and down. That's just for a one-day period, so it's huge. Now here's even a bigger one. Here's LinkedIn, excuse me, and its earnings were after the close, also on the 28th, one day to expiration, which would be the next day on Friday, and its expected move or implied volatility was over 250%. Normally it's 50, so you can see that these potential is huge for these big, huge implied volatilities, which is an indication of a big spike in the price of the stock, either up or down. So it's for this reason it's essential to have a watch list of stocks to monitor closely due to the fact that they may not all present an equal trading opportunity for an earnings trade. So you want to remember that the goal is to take advantage of this temporary rise in the volatility, as well as also then looking at the past earnings performance of the various stocks you're looking at to see if they've been consistent on what they did after an earnings release. Did they consistently explode up or down, or did they just, go and just collapse and just go nowhere? So this is what the tendencies you're looking for. And we have the statistics that we can do that. So these earnings opportunities are, again, they're all about probabilities. Now, here's the 3 cycle type trades again. So we're going to go through, I'll show you some examples. So you've got that trend trade into earnings. Then you've got an earnings release trade, which is, I always do non-directional. And then you've got a post-earnings potential trend trade. So these are 3 opportunities that you can have on any specific stock. Sometimes one stock may have all 3 of these type trade setups. So here's Amazon again, and Amazon, you can see here, it's just a beautiful downtrend, right? All the way down here into its release of the earnings right there, that kind of telephone. So you want to take advantage of this directional trend if you can, if it's trending, and you want to always buy options as you're going into an earnings release. So you want to buy options of the week of the earnings series of the release. So if this was like a weekly option for next week or something, you'd want to be buying this puts next week. And the reason you do that is because you want to take advantage of the implied volatility increase. Now, let me see if I get this. Now, the thing is, when you're going down like this, those puts are going to go up in value, right? So you want to buy puts. You want to always go long options going into an earnings release date. And that's because, well, if you get the trend right, so you're going to get that delta increasing the price of your option. But the other thing that's increasing the price of the option is the implied volatility is increasing. Okay, so as you can see from that couple slides back, Amazon is typically about 33% implied volatility. But as it was getting closer to earnings, it was up over 155. So a big component of price on an option is implied volatility. So you get a twofold effect. You get the delta pushing price up and you get implied volatility. But you want to be out of that trade on the day of the earnings release because why? Look at that pop to the upside. So that's a separate trade. Keep it separate. Now that's trade 1. Trade 2 is then you exit out of, if you have that first trade, be out of it before the close of the day of its earnings release, and then put on directional trade. So in this situation, you could see that Amazon had an explosive move to the upside. So it went from trading at about $310 to trading up here to $350. So a huge spike, and the trend had been down, and then all of a sudden it reversed and it's up here. So this is a separate trade based on a spread trade where you take advantage of a spike up or down. You don't care which direction. I'll show you in a little bit how that's done. And then trade 3 is you get a post-earnings trend. So after it spiked up here, took a couple of days rest, then it just started trending post-earnings. So potentially 3 trades on a lot of these stocks. So this is what you want to look for and have a watch list to try to identify these setups. Now, Apple last go around, or back in July of last year, had all 3. You can see it had a nice, beautiful trend up. So you want to get out of that trade before, on the day, either before or on the day of its earnings release, before the release, and then you see it spiked and collapsed to the downside, and then it just trended lower. So that's why it's really important to take these as 3 separate type trade setups. If you're taking a trade thinking, you're going to take it into an earnings release, so many times you're going to get, flushed out. Now, the other thing I want to show you is the implied volatility back here. If I back it up, here's that implied volatility, and this is what I was trying to point out. You can see how it's increasing to the upside, and then as you get into earnings release right here, after the earnings are announced, the uncertainty is gone and it collapses. So implied volatility always collapses after an earnings release because that uncertainty is taken out of the security. So basically, a stock's option will need volatility, and without this volatility, you're going to have no price movement, And then without price movement, you pretty much have no chance to turn a profitable trade. So then how do you find that volatility and then turn it to your advantage? Well, it's for this important reason, again, volatility, that I put together a process that I use to build out a good trading list of stocks to look at for trading into an earnings release. So I look at, I'm looking for those stocks on past performance that have a high volatility increase going into an earnings release. And I also want to make sure that they have weekly options, or that I can trade an option during the week of its earnings announcement. So the screen will track the stock's volatility. I will look to, do a screen that shows me those stocks that have 1 million shares per day or over, so I can have liquidity for trading. And then I'm going to monitor the straddle cost. That's how you decide, or that's how you factor in or put together what the volatility is going into the earnings release. You monitor the straddle cost. That gives you the volatility. And then 4, I look for the pre-earnings implied volatility of what it's done over past earnings announcements. So I'm looking at that expected implied move, and then I'm looking at what did it actually do after an earnings announcement. And then 5, I'm going to keep track of that post-earnings move, and I look at the 1 day to all the way to 21 days. So I have these statistics, and then I can go through these stats and see if a specific stock has had a consistent pattern leading up to an earnings, at earnings release, and even after. So the one major element to trading an earnings release successfully then is knowing that stock's implied volatility. And that's also referred to as the expected implied move of a stock or security. So by knowing that, then you're going to use this information to tell you how to do the trade setup. So this number, the implied volatility or the implied move or the expected move, which is referred to, is expressed as a percentage of the stock price. And it basically is indicating a theoretical 1 standard deviation move over the course of that stock's option cycle. So again, this is a theoretical statistic that for options we can use for forecasting the probability of direction of where it could go. And this is the kind of the foundation of an earnings trade. So here's an example. So this will show you the implied move. Again, it's theoretical, but this is where we always start out with trying to decide, what option strategy to use. And we use this implied move to do our forecasting. So in this example, you've got Google, and it's trading up here. So this is, a normal distribution curve showing distribution of price. Now, when you look at your option platform, you're always going to be given the at-the-money price right here. So we're going to put that at the top of this curve. And that's because the at-the-money is where all pricing starts for options. That's where all the supply-demand is. Now, once this number, the at-the-money stock option price is determined, then the other outer strikes for calls and puts are determined. That's called option skew. So you're given 3 days, in this example, so you're always given days to expiration. And you're always going to be given an implied move. So in this example, it's plus 4%, minus 4%. So the way we use this then is we look at the at-the-money price, and what it's telling us is that it could go down 4%, which would be down to 480, or it could go up 4%, which would be 520. Now it's this movement from 480 to 520 is the expected move, and that's also 1 standard deviation theoretically. And now 1 standard deviation is a 68.2% probability. So by knowing these 2 points, we can say theoretically the stock of Google for 3 days to expiration, the probability is that it's going to move between 520 down to 480, and the movement will be between these 2 numbers. So it's going to be 68.2% of the time it's going to be between these 2 numbers. Now, if it explodes outside of that, that's outside that expected move of 520 up, or if it explodes below 480, that's outside the 480, which is the expected move down. So this is what we're going to use to set up our targets, the expected move. All right, so that's very key, and that's key for any type of option trade. So it's great, useful stuff. Now, this implied move is again what the marketplace theoretically expects the stock to do, and it's the best way to calculate that move. So although it's not going to be 100% accurate, the implied volatility and using this implied move of the stock, it's a very useful tool to use for your targets, and it's free, so you might as well go out there and learn how to use it and take advantage of it. So then step 3 is, I like to have things as systematized as I can. So I've got a checklist to systematize the trade setup. And, you want to have things as systematized, kind of detach your emotions from your trading, and to make sure you do the same process over and over so you don't make mistakes. So what I'm looking for is, again, I'm looking for those stocks. They have to have options, and they have to have option liquidity. And they also have to have options in the week of a expiration or the earnings release. They must have high pre-earnings volatility. I want high volatility because I want a potential for a stock to move big up or down. And then the other thing I look at that I factor into my screen or a filter is that I want to look for price movements of, on average, of greater than 5% up or 5% down over at least 4 earnings seasons or cycles. And I want prices of over $40. So I like to trade options on stocks with high prices, because if you're trading a $10 stock and you get a 1% move, that's barely any money, right? But if you get a 1% move on a $100 stock, that's pretty good price. That's pretty good potential profit. So I pretty much cut it off at 40, but I actually probably should change that to 50, usually 50 and higher. And you'll see that the ones that perform the best are the ones that are going to be over $50, over 70, that kind of price. So then you're going to look to calculate the implied stock move on the day of its earnings announcement. That's what you're going to need in order to perform your earnings price target analysis. And then from that target analysis, you can select the right weekly option strategy, your entry plan on that, and your exit plan. So you have everything kind of mapped out before the trade's ever done. So here's kind of the process I go through. So I've got this earnings data, and this shows me everything I need. So I can go back on any stock and pull up this data, and so I can go back over all the different earnings cycles. And you can see here again, this is Amazon. And so the last earnings cycle on the 28th of April, so that was the last season. You can see here it closed at 6:02 on the day of its earnings. And the expected move or the implied move given to you that day was for it to go up 7.9, say 8% up or down. So that's saying that the market was telling you theoretically they're expecting Amazon after this earnings announcement, 1 day left, to go up either 8% or down percent. Now you can see all the past statistics here. So Amazon has a pretty big expected move, over. This is going back 9 cycles. So I've got all that data in there. And then the big key here is then what did it actually do? So here's what it actually did on expiration. So I come down here and I'll look, okay, so Amazon last earnings season actually was up 9.56. So it exceeded the expected move of 8%. It actually closed up by expiration of 9.5. Here it closed down almost 8. Here's up 6, 9, 14. So very, very consistent pattern for Amazon. It has big moves up or down. And what you'll see is that it tends to exceed that expected move that the market's saying it's going to make. So here's my little earnings worksheet. Put it into a spreadsheet here. So here's all that data. Here's last season 6:02 close, expected move, up or down 7.96%, but it actually closed the next day, Friday. This was a Thursday. Expiration was the next day. It actually closed up 9.56%. So that exceeded it, right? Now, the interesting thing is when you come down on Amazon, a lot of these, this is when you take all nine cycles or seasons, here's the average expected move given by the market, 8% up or down. When you come over to see what it actually did, it almost moved 10% up or down over 9 cycles. So this is a great one to trade because it's very consistent. And the smallest move it had over the last 9 seasons was just a 6% up or down. So think about it. If you could set spreads up inside 6%, that's 100% reliability or 100% winning percentage if you can set trades up 5% or less. So that's the key. So that shows you that consistency. That's what I'm looking for there. Now, step 4 then is those weekly options. Why to use those weekly options? So weeklies are still one of the most lucrative trading opportunities out there today because they offer defined risk, very low cost, and they're highly levered returns that you can get from them. Now, here's the mechanics that behind these weeklies that give you the great advantage for these type of setups. And I use the weeklies, like I said, on all these earnings trades for 2 of the key components or elements of value or price, and that's time value and implied volatility. These are the 2 main components for pricing an option. So by combining these 2 elements, when you use it correctly, it really creates a great winning kind of low cost defined risk trading formula that you can use for generating some really high returns in a very short period of time. So when you're pricing an option, the 2 main components again will be time value and implied volatility. And you can see from that earlier example, when you're going into an earnings release, that implied volatility is going up big, and that's pushing the price of that option higher. So if you were long calls and it was trending up, the implied volatility would be helping that long call option go higher. Or if you're long puts and it's going down, that implied volatility increase is going to help the price of that put. So, and then the time decay, when you're looking at weeklies, I call it turbo time decay because it's so swift. It's like 12% a day. So if you're doing an earnings trade like on that Amazon where you have just one day, you're in a trade for one day, you can buy really cheap options because your time value of that option is pretty much almost all stripped out. So that's the other key element, that time portion of it. So again, if you know which weekly option strategy to use for your earnings trade, how to construct the trade, when to execute it, then these weeklies can really give you some exceptional fast profits due to that incredible leverage they provide, and it really makes it a perfect vehicle for your earnings type trade. One second here. I think I'm okay. If everybody hear me okay? I had a flashing light, but everybody okay here? Okay, great. Thanks. Thanks, Sylvia. So the next thing is, well, then how do you select the right strategy? So for whatever trading strategy you're comparing, you should use the same kind of analysis, and I call it just kind of like a comparative option strategy analysis. So when you're looking to construct a trade, you want to compare, those particular trades, the risk to reward, or the return on capital at risk of the various strategies you're looking at. And then you're going to decide based on that, your return on your capital, which strategy to use based on the risk reward of your trading goals. So, some of you here in the room might be more aggressive and want to take more risk than others. So by doing the risk reward analysis on the various strategies that you can use, that helps you to select the best one for your trading goals based on your risk. So there are going to be times when you can use more than one strategy, and this is how you decide which one to use or a combination of strategies to use. So this is a trade setup from the last 4 earnings seasons using my favorite non-directional weekly option strategy. So I'll show it to you in just a minute, but basically what you can see here is that these are very short duration trades, 1 to 3 days, and the returns are very, very consistent. They're about, anywhere from 5 to 25, maybe 30% is a big one. But the whole key to this is selecting the right stock. And so here's Q4 2015 again, 1 to 3 days, those returns of 25% or so. And that's what I'm looking for. You can make bigger returns, but then your probability of winning sometimes suffers. And then Q1, same, 1 to 3 days, 1 to 4 days, and then same returns. And then last cycle, 1 to 4 days, and the same kind of consistent return. So the key is the selection of what you're looking at for that trade setup. So step 5 then is, well, what is the strategy, and then how does it work? So there are several different methods to capture profits from an extreme price volatility that surrounds every earnings season. And each method works best based on certain circumstances. So I don't like to have to spend a whole lot of time watching my trades all day long. So the method I like to use, and the one that I teach most often, involves almost no work once the trade's placed. So basically it's just a 4-step trade setup. So you're going to buy 2 options and you're going to sell 2 options. Now this may sound like a lot of steps for some, but once you understand the method, you just use this same strategy over and over each and every earnings season. So it really becomes pretty simple to you. So here's how it works. And this was on an earnings trade setup, again, on Amazon. So in this particular trade setup, Amazon was back when it was down around 337, but it was trading at 337 going into the close, the day of its earnings release. So step 1 was to buy the 345 call, paid $660. That was debited to your account. And then you sold the 350 call above it, pulled in $495. So you kind of financed it. So your total cost is $165. So that's a bull call debit spread, step 1. Now step 2 is then you're going to buy the 325 puts, cost $620. You're going to sell the 320 put below it, cost that brought in $455. Your cost again on this spread was $165. So the profit then is your difference in your spread. So 350 minus the 345, that was your spread. So that's $5 or $500 per option contract. Your total cost was $330 for both of those spreads. That's your capital at risk. So that's all the potential loss. The difference in these two gives you your profit per option contract before commission. So this trade made $170 per contract before commissions. It was set up as a really high probability trade based on the earnings statistics. The maximum potential loss when you going in was $330, so you had that defined. The trade was in place for only 1 day. So if you had $1,650, you could have bought or done 5 contracts, $170 per contract profit. So that's $850 for that one trade. Now that would be a 51.5% return on your capital. And the time the trade was 1 day, it took about a half an hour to get it set up based on working the trade. So once you have done all the homework, then the trade's pretty easy. So bottom line, this strategy is what we call the iron condor. It's a non-directional option strategy, and it's ideal for trading an earnings release. So it can be used to capture that explosive price move that exceeds that 1 standard deviation implied move that the market expects that I showed you. So it can exceed, that explosive move up or down. It can be set up for that kind of trade, or it can be set up, constructed as a volatility collapse. Because after, you see the volatility run up into earnings, but it always collapses after. So you can also set this trade up to take advantage of that. So it's a really kind of dynamic trade setup for these types of trades. So here's an example. We can go through this one again. So again, this is coming back to Amazon. On its last earnings on the 28th, the earnings were coming out that day. So you can see that 1 day to expiration on Friday, its implied volatility was up over 133%. Expiration was the next day. So 1 day, huge potential movement up or down. The statistics here look really good. This is very consistent. You can see the expected move here over 9 cycles is 8% up or down, but you can see that it actually over 9 seasons has actually closed almost up or down 10%. So this tells me it's a great setup for this kind of condor spread. So that's the first thing. That's the most important thing there, is to look at the statistics on each of these that you're looking at. So then the trade setup was easy. I just wanted to set up a trade where I looked at that. I knew that the lowest move that it had over 9 cycles was 6%. Right? That was that lowest move up or down. It had a move of 6% up. So I set up a spread at 5% inside of that, 5%. That would give me potentially 100% probability of this trade being a winning trade. So by doing that, this was the trade setup. It was buying the 630, 632.5 calls, buying 577.5, 575 puts on a spread. It cost me $200. That's $200 debit. It's a $2.50 wide spread. Now you could have done this as a $5 wide spread, $10 widespread. So you could increase your profit, but that also increases the risk. So, I keep it real low risk. My max profit would be 50 per contract, and that would be a 25% return. And that's based on the probabilities that this had a high probability to be over 6% at expiration. And this is actually what it looked like when you charted it out. So here was the expected move, was for it to be up or down 8%. So here's your 8% up, that was 650. Here's your 8% down, 554. It actually closed up 9.56%. So right here at 660. Set the spread up down here inside of that. So had this set up at 5%. So this gave me, based on past statistics, 100% potential winning probability. So just keep my fingers crossed that this continues. So that was the trade. So it closed here and it exploded up here. One day later, it closed at 660. The spread was total profit on that trade setup. So that's the what I'm looking for. Now, will every trade be a winner? No, which I wish we could, but I guess if every one of your trades were a winner, then you'd get bored, right? So you need to be able to find the highest probability trades. And with a high probability systematic approach that I use, you can achieve a very high trade winning percentage. So it really comes down to your selection and looking at those past statistics. So it comes down to using a very selective and systematic selection process, which I have incorporated into my trading. And, I spent a lot of time, working on these strategies. So, when I was running a trading group, that was most of the work you were doing was research on different strategies that, would be good high winning probability trades. So that's what I'm really always focusing on. Now, the other type setups that I mentioned were these pairs trades. These are what I call market neutral strategies. So they're really cool. You can use pairs, and this is a spread, okay? So when you're going into a pre-earnings or post-earnings trade, I found these to be very, very useful. So what this does, it matches a long position with a short position in a pair of correlated instruments. So these correlated instruments could be two stocks, it could be two ETFs, it could be a stock and an ETF. And then it waits for either strength or weakness in the correlation, and then goes long one versus the other based on momentum from an earnings event. So this is how I use the pairs. I'm looking to, say, go long if you had a potential for a big move up on something like, say, a Netflix, which I'll show you. Then you go long Netflix and you offset the risk, systemic risk overnight, by selling something against it. So this strategy profit is derived from the difference in price change between the two instruments. So the term hedge fund comes from this pairs trade. Hedge funds are big in pairs trading. So when we were, trading, probably 70 to 80% or more of all of our trades were spread trades, because that would offset some of your risk. So here's an example of a market neutral pre-earnings trend trading strategy on Netflix and QQQ. Now, I do these strategies, these trade setups, using synthetic options versus, say, going long Netflix and short QQQ. So you can structure these with synthetic options. It makes it much more efficient and less costly as well. Plus, a lot of times you're not going to be able to borrow shares to short. If you set up a synthetic option structure, you don't have to worry about that problem. So here's what it looked like. This was back in January, and Netflix earnings were right here, on the 19th, right there. So this had a nice momentum spike going up. So the trade setup was going long Netflix right here on the 5th, okay? And then the offset of that, to offset the risk in case, the market's cratered, was to short QQQ. So it's a really good correlation for Netflix and QQQ. So what you see here is that Netflix, you can see Netflix hardly went anywhere. It went sideways, right? So Netflix holds here, and QQQ, though, gets crushed and drops. So that's how that spread worked out. So it was a beautiful actual trade setup. You didn't have to actually have Netflix going up. So if you had just gone long Netflix into a pre-earnings trade, you would have broken even probably. But by doing this as a pairs trade, it actually made over $1,000. So the spread ended up making $12.76 per share. So let me show you what the spread looked like. So if you map this spread out, you would see that going into the trade here on that day of the 5th, Netflix was $1.55 under QQQ. So right here, this is the spread. This line here is showing you the spread value. So it was actually right here, Netflix was under the price of QQQ. Now, you saw that from that prior chart that QQQ actually got crushed to the downside, and that blew the spread up. And so the spread went to $11.12. So you got it at $1.55 under, went to $11.12. So that's an increase of $12.76. So that's a gain on if you did 100 shares or one contract on a synthetic option, that's $1,267. Okay, so that's the key. So this is a really nice correlation, but I love these type setups for that kind of reason. Let me see something here. So I'll get into your questions here in a second. So that's a pre-earnings trade. Now you can do the same thing post-earnings, and I love to look for these type of setups. And here is just another one. This was actually the same earnings season. So here's again Netflix for a trend trade strategy after earnings came out. Again, synthetic options were used. So here the earnings were released on the 19th. Okay, that day of the 19th. Right here, okay, and you can see Netflix then started trending to the downside. So here was shorting Netflix, but also at the same time going long QQQ. So you can see that Netflix got crushed to the downside hard, and actually QQQ trended up to sideways. So again, that was a really good spread setup. Now spreads are fantastic because you've got about 4 or 5 different ways that you can profit from a spread. So you could profit from a spread in this situation if both go down, you know, Netflix and QQQ go down. You could profit from this trade if Netflix goes down and QQQ stays flat. You could profit from this trade if Netflix stays flat and QQQ goes up. So, you know, there's all these different combinations. So it makes spread trading a really great dynamic or part to add to your portfolio. And here's what the spread looked like when you map this out as a spread. So here it was after the earnings release. This was on the 21st, okay? Took a day or two to see what the trend was going to do. So this was selling Netflix, buying QQQ, and at that point in time, Netflix was trading 30 cents per share over QQQ. Then you can see the spread. It just got crushed to the downside, rolled down hard. And at that point, the spread was minus $14. So at this point, Netflix went from 30 cents per share over QQQ to $14 under. So that's a total per share of $14.30. And on a one contract basis, that would be $1,430. So different ways to trade, different ways to slice the pie. But I like to look at these different advantages that you can get from different, you know, market kind of setups and conditions. So I wanted to, you know, show you and kind of show you some other ways to look at the markets. And when you go into earnings season, we're going to have even, you know, higher volatility of the markets. The markets are already kind of crazy. Now, when you add that earnings part to it, it's going to be even crazier for some of these stocks. So hopefully this kind of sheds some lights on some things that you can do to get you started. And now I'd like to talk a little bit more about how you can start profiting from this earnings season using these weekly option type of trade setups. So I've got a course that I did just a couple months back. Now it's on demand. So it's a fantastic course. It's a special earnings workshop course I did, how to profit from an earnings season now. So it's an on-demand course. It's a 5-hour course broken down in 30-minute modules. And you get my PowerPoints. My courses are very detailed. And so it's all here for everybody here today. The first 20, I like to keep the groups real small. And so here's the link if you're interested in it. You get a money-back guarantee for it. So it's a win-win situation for you. If it's not for you, you know, just send us an email. We'll refund your money. But here's everything you're going to get. You're going to get this, I call it my blueprint course on how to trade earnings using weekly options. It's a 5-hour on-demand course, all in 30-minute modules, so it's easy to follow. You get the PowerPoint, 237-page PowerPoint. You can print that out. I'm a kind of a paper guy, so you can put it on your desk, take notes. Then we're going to do a live follow-up Q&A support. So, you take this, you have questions, come in, ask questions. This will be recorded. Now, I'm going to also give you the best stocks to trade into earnings. I'm going to give you a nice list that I put together for these stocks, and I'm going to give you a list of pairs trades that you can use for pre and post earnings. I'm going to also give you as a bonus my Greek Power Tool Guide and my complete option strategy manifesto. So a lot of great stuff there. MoneyBack Guarantee, and for the first 20 today, you'll get all these goodies. Now, the thing is, let me just show you here. Okay, here's the link again. Just you can click on that or just copy it, paste it into a browser, and then it'll pull up your payment link, and you'll see it's $97. But everybody that signs up here today, the first 20, will have your record of it, and you'll get all these bonuses that I showed you. Now, here are a couple of past people that took the course, and this is from Dave. He said, I've really enjoyed your trading earnings course. I found that your training is easy to follow and duplicate because you show step by step exactly what to do, how to do it. Everything that I've received from you has been top notch. And then that was Dave, and then said this from Blessing. He said, Larry, thanks for the teaching me and others the earnings trading system. I just made good money on GMCR on a short iron condor and CRM on an iron condor last week. I have a 90% winning rate, paper trading, and now live trading using your methodology. Looking forward to the next earnings season. So, it's a great compliment to get that feedback. Now, the big thing is the stocks that you're going to trade. So you're going to get as another bonus 2. Bonus 1 is the live follow-up Q&A. Bonus 2 is the stock watch list. So I'm going to give you a couple different watch lists, and I do a screen for these. And so this will give you the top earnings watch list that I like to look at for stocks. So I do 2 different types of screens. One screen I'm looking for those stocks that have a movement at expiration of plus or minus 5% or greater. So I'm screening, looking for these specific stocks for those explosive type moves. And then I do another screen looking for those stocks that have hardly any movement, 4% or less. So these are the stocks that you could look at for maybe an implied volatility collapse type trade setup. And then I give you my earnings pairs watch list, bonus 3. And then, so here's an example of the watch list. Last go around, you can see everything here, the symbols, Netflix, etc., the market where it's traded, average volume, the earnings date. And then I give you the strategy, if it's an iron condor debit or credit spread. Does it release after or before the market closes? And then I give you, going back 5 cycles, what did it do at expiration? So you can see, Netflix was down 6%. Here's Goldman Sachs was flat. So this will go back further, but this was what it did the cycle before, and then you'll go back another 4 to show you what those were. And then you get bonus 4, my 15 option strategy guide covering my favorite type option strategies. It's a nice printout you can put on your desk. Shows you a diagram of the options. It gives you a description of the various ratio spreads, etc. And then bonus 5, my Greek Power Tool Guide. This is a printout that you can print out and use for your guide to the Greeks. If you have a quick question on a Greek, you can just put that on your desk and you're ready to go. So that's another bonus. And then for anybody that's never been a member of my trading club, I'm going to also throw in 1 month free to that. So everything here for $97. And in the trading club, we're open every day, virtual trading room from 9:15 a.m. to 4:15. Do daily market updates on videos for you every night. We have a live Q&A every week, hour and a half, Traders Education Vault. Every month you're paying member. You get credit, and discounts on courses and all my trading tools and indicators. So really great package here. Here's the link again, and I've got 20 spots open because I've got save room for my members, and I want it to be small enough where I can have the live follow-up Q&A small enough where we can get all the questions answered. And here's what's covered in the course. Let me see. Okay. Yeah, so how do you find the correlated stocks? I give that to you in my list. And here's what's covered in the course. So you're going to get my 3 favorite non-directional weekly option strategies for these earnings type trades. These are all defined risk, non-directional strategies. Each strategy explained in really great detail with lots of examples. And then I'll show you my unbalanced non-directional strategy. So this is where you can, if you have a little bit of a bias to one side or the other, say you think, Facebook might go up, you can structure this trade where it's non-directional, but with a little bit more pop to it to the upside than the downside. So teach that in the course, step-by-step guide for using the stock pairs for catching those pre or post earnings trends. Now this alone is worth the course price right here, just to see how to pair trade and then how to do it using these synthetic options. So this is really cool stuff here. Once you see how to do that, you're going to love it. So pairs trades using synthetic options for the long or for the short. And then how to select and construct the best non-directional weekly option strategy based on that stock's pre-earnings implied projected move. That's a big part of it, to understand everything about that, how to calculate it, how to use it, how to calculate that implied move, and then how to use it to set your price targets. So big part of the course there, but it's all kind of detailed step by step. And then how and when to use these trade setups, how to manage into expiration, how to defend. My statistical resources, I give you what I use for all my earnings data that I showed you, and then how to use these statistics. So you can have the statistics, but if you don't know how to incorporate and use it, then it's no good to you. So all that for these non-directional and the pairs trades, etc. And then you're going to get my 32 trade library. So this goes and shows you all these past earnings trades that you can go through and look at, see how they were structured and why they were structured, etc. So a fantastic amount of information and content, and all just for $97, and all with the money back guarantee. So a pretty good win-win situation for you. Hopefully you'll want to get prepared and you'll sign up and join me. So I look forward to it, and money back guarantee. So that's hard to beat. So any specific questions here? I've got a little bit more time left, and yeah. So I've got 5 spots left, and if you're interested, please sign up now before they're gone. I appreciate that very much. Oh, question, why was I trading in Bermuda? Well, the guy that owned the company that I worked for about 18 years, he was Dutch, and Bermuda is a tax haven, not for a U.S. citizen like myself, but it was a tax haven for him. He was Dutch. So the company was incorporated and set up there for trading offshore, all the offshore trades. Then there were no taxes. He had to pay no taxes on them. So that's why a lot of companies are set up, in Switzerland and Bermuda and the Caymans and stuff for that kind of setup. Yeah, you're welcome. So I was fine with it. It was great. I was happy they were set up in Bermuda. It was better than some of the other places that can be set up. So. Bermuda, they have no taxes there, but it's very expensive. They have other ways to get your money, but they don't have any kind of income tax. But they have property tax, things like that. So yeah, this course it'll give you everything you need for these types of trades and more. So that's pretty much it. So powercycletrading.com/TOP, and that will give you everything you need. I have no idea how to fix the screen. I'm sorry about that, Dave. So if you're looking to start taking advantage of some of the volatility, sign up here today and look forward to working with you. And this is a great package. You're going to get everything you need and then some. And the other great thing is there's a money-back guarantee, so it's a totally win-win situation for you. How many people here trade options? Put in a 1 or something if you trade options. Or put in a 2 if you don't. More people trading options than not. Options are fantastic. They might be a little bit more complicated when you first start out, but once you get the basics down, you're just going to love all the options that an option gives you. So it's just amazing what you can do with them. But I keep everything pretty simplistic. So this course is very, very simple approach. Seems confusing, but it's not. So within a hour time frame, it's kind of hard for me to step you through it slowly, but that's why the course is 5 hours. But it's also broken down where they're in 30-minute modules, so you don't get totally brain dead going through it. You can take your time, or you can go back to certain sections that you need or something, So it's a great way to get started for $97, and it's a fantastic course. It really is. Plus all the other goodies you get with it. So hopefully you'll see the value of it and take advantage of it. So, well, learning stock trading is actually trading is really learning direction, right? So the first thing you need to learn is how to trade directionally. So it could be stocks, futures, whatever. And once you have a good feel for directional trading, then the options really come in handy. Because sometimes you can get the timing off, and options can give you that added benefit of timing if you're not exactly perfect. Yeah, so use that link, powercycletrading.com/top. Here it is one more time. And again, thank you very much for taking some time out today to listen to my presentation on earnings. So good luck trading, and appreciate everybody being here. So thanks again. Tomorrow's a non-farm payroll number, so be careful. Hey, thanks, Morris. Thanks, Jim. All right. Thanks again. Ciao. Oh, good, Sandra. You're in. Awesome.